This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Ken?
Cody?
How are you?
Well, it's good to be back in busy Vancouver, sitting in the studio with you. What more could a guy want?
There you go. I haven't seen you in a while.
I know. You're losing weight. You triathlon. You never told me I was losing weight.
You look good. You look good.
Thanks.
The summer in Penticton treated you well.
Yeah.
Good.
A little smoky, but other than that, pretty
Nice.
good.
Awesome. Okay, well, we're going to get right into it for everybody here. Appreciate everybody taking the time to obviously view this video. Join us as we give you guys an update on what's transpired over the third quarter and kind of what we anticipate happening as we head into the remainder of the year and the fourth quarter. So I'm going to pass it over to Ken. He's going to do his little spiel, as always, on his thoughts on the market, and then pass it over to me to go through a couple points on the mandates, look at some of the strategies that we have heading into the fourth quarter and kind of our thought process and how that relates specifically to our mandates as a whole. Yeah. So Ken, I'll turn it over to you. You can go through obviously your update and I'll control the slides from here.
Perfect. Well, thanks for watching. I'm not going to sugarcoat this. Trying to figure out where we are in this macro picture is extremely difficult. Inflation has started to peak back up. The Feds met last week, and now the old saying is we've gone from transitory to pivoting to the new buzzword being higher for longer. So I really don't see how the markets have come under this much pressure, especially this week. NASDAQ will probably close down in the neighborhood this week, somewhere right in around 4%. That hasn't happened since December of 2022. We've seen, as you can see here, the Toronto Stock Exchange, pretty lacklusterous performance there, up barely 2% year to date. A lot of that can be on the utility stocks and also the bank stocks. The banks' earnings weren't as good as they were in the U.S. You saw larger loan loss provisions in Canada. So most of the banks, including Royal Bank, are all slightly negative on the year, anywhere from down 2% to down 4%. And what you really truly need to understand is that as interest rates go up and where they are today, it makes dividends less attractive.
Exactly. Like if you take a look, kind of quick stat, like we take a look at just the Toronto Stock Exchange only being up 2.9. But if we take a look at the TSX Dividend Aristocrat Index, which is just companies in the Toronto Stock Exchange that pay dividends, year to date, as of the same date there, September 21st, it's actually negative 1.7%.
Yeah.
Right. So dividend stocks have gone nowhere specifically because of what's transpired with rates.
Yeah, and that's why the Canadian market is where it is today. We started to see, obviously, NASDAQ is still up over 26% year to date. I think what's even more important is if you go back to the lows of October of 2022, NASDAQ's up an amazing 40% from the October lows. So even though we've seen a 4% pullback this week, still up over 26%. You've seen the S&P at one point was up 16%. Now it's backed off a little. It was down 3.5% this week, in line with the Canadian market down 3.5% as well. And what we haven't seen with the Dow is the Dow has more value stocks, dividend paying stocks. And we started.
It's also a price weighted index too, right? So you don't
Right.
have those large market capitalization companies such as the Apples, the Amazons.
Yeah.
With a market cap weighted index, those tend to take over as they grow, and that's why you look at the Dow, it's nowhere near what obviously the NASDAQ or the S&P 500 has done.
Yeah, and what's interesting is, the markets peaked in late July, and we started to see more of a broad-based rally, and it wasn't just about the 7 mega cap tech stocks, and we started to see that rally. And since the Feds have spoken and have said that there's 2 Fed meetings left this year, okay, and they say that they'll probably hike at one of them, leave one of the meetings rates untouched. But you got to put that into context. We've gone from near zero. Rates have gone up 500 basis points or 5 percentage points. So ask yourself a question logically. Like, what is another quarter point? Well, it's probably priced in. I mean, look at the magnitude. What's another quarter of a point based on the fact that we've gone up 5 full percentage points? Yeah. And I think the bigger picture is the fact of the Fed saying that now there was priced into the market for 2024. There was going to be 3 rate decreases by a quarter of a point for 3/4 of 1 percentage point. And now they're saying in 2024, there will only be a quarter point drop. I'm not so sure you should believe that. And when everybody says the same thing, it's a challenge. And what's interesting is, this is a great article. Wall Street comes to grips with how wrong it's been in 2023. So many strategists and economists have got this so wrong. They were so bearish, and then they changed their tune. You had Michael Wilson at Morgan Stanley. You had Bank of America. S&P in late July is up 16%. And now everybody's taking off their bearish bets and going bullish. So
That's why you see the recession probabilities, like you've outlined here, change dramatically.
Exactly. Over all asset classes. Look where we were in August, just on the S&P 500 at 22 probability, and these are priced in across all the asset classes, and now it's at an astounding 98. So are we going to get a recession? Well, everybody's talking about a soft landing. So let's go to the next slide and let's talk specifically about this point, because it's getting a lot of press and everybody's talking about it. We all know the yield curve's inverted. As of today, a 2-year U.S. Treasury was 5.12%, and a 10-year U.S. Treasury was 4.5%. That extreme inversion is the most extreme it's been since 1981, 1982. The interesting thing is the yield curve inverted in July of 2022, 14 months ago. So if you go to the next slide, everybody is saying, oh yeah, the bears are still out there in full force, and they're saying, yes, the yield curve is extreme, it's inverted, and it is basically predicted all of the past 7 recessions. Well, that's not necessarily true. If you Google it, that's the answer that you will come up with. But in 1966, the yield curve was inverted. We didn't get a recession. In 1998, late 1998, the yield curve was inverted, and the recession didn't come for 3 years later in 2021. So, yes, you can look in the rear view mirror to try to extrapolate what you think is going to happen in the future. But also, saying that this time is different could be very dangerous words as well. But just because the yield curve is inverted, it doesn't necessarily make complete accurate forecasting to say we're going into a recession. Again, we told you at the beginning of the year, hard to have a full-blown recession when you have full employment. We have some of the lowest unemployment rates in both Canada and the U.S. in the last 40 years. We've got wage growth, which is helping. We've got a resilient U.S. economy, and you've got a resilient consumer. So are we going to achieve a soft landing? Well, I'm going to write extensively about that in the third quarter wealth notes that you'll receive in early October. Is there a chance? There is a chance. A lot of the bears will say that's just false hope, and there's no question we're going into a deep and nasty recession in 2024. And right now, even though rates will probably stay higher for longer, I really don't see that happening, a full-blown deep recession. So if we go to the next slide, another strength here is the fact that corporations got this thing completely right. 2 years ago, a year ago, when interest rates are near zero, corporations borrowed billions of dollars at low interest rates, put the money on their balance sheets, didn't spend it, and they're in great shape. Corporations have absolutely nailed this thing. I don't know whether it's luck or whether it was great planning. Maybe it's a combination of both, but you can clearly see that most of the debt on the S&P 500 companies doesn't come due till after 2030. So we've got 6 years and a quarter to go before this becomes a problem. And this is obviously a key point. This slide reflects the fact of why corporate profits and why 80% of S&P 500 companies in the second quarter beat their earnings estimates, okay? Because it's not getting impacted, those higher costs. Where it is getting impact, which is a challenge for the markets, for the economy, is that government debt is in the U.S. is out of control. As of the other day, it hit $33 trillion. Obviously, that's a new record. The challenge is if you've got $33 trillion in debt at interest rates near zero, you can handle that. Mm-hmm. But when you have the escalation that we've seen in interest rates, the cost to service the government debt in terms of interest costs,
the interest payments
is just gone up exponentially. It's crazy. And the U.S. consumer isn't any better. I mean, $33 trillion government debt. The U.S. consumer just set a new record last month, and they have $17 trillion in debt. That's a concern. That's a worry. In Canada, it's bleak. Out of every G7 country, Canada has the highest debt, consumer debt, out of any G7 country. For every dollar of take-home pay in Canada today, Canadians owe $1.85. That's not sustainable long term, especially if rates do indeed stay higher for longer. So another good aspect on the next slide is why we're still somewhat cautiously optimistic still for the balance of the year. We need to get through October. Who knows if we get a Christmas rally, but historically November and December have been very good months for the market. But if you go back a couple months ago, the U.S. dollar had a great run at the beginning of the year, and then towards the middle of the summer, you can see the big dive downwards, and that's when you were taking a look at Russia, India, China, all saying that, you know what, we are going to try to establish and take away all the U.S. dollar trade. Yep. And we're going to try to trade, and same with Japan's doing the same thing, whether it's the won, the yen, the ruble. But the reality is the U.S. dollar, I've always called it the Kong dollar, the king dollar. I mean, the reason why it's gone on another trajectory is simply because the U.S. economy, number one, has been resilient. Mm-hmm. So it's still viewed as a safe haven, and rates have gone up, making, if you have U.S. denomination and you've got higher rates, you can see, that's had a big impact. It puts pressure on the rest of the world. China's GDP is falling. Goods from China become more expensive when you have to pay for them in U.S. dollars. So I think this trend is going to continue because I think if you thought the markets were volatile, I think the volatility is going to continue to be there for the last quarter of this year. And I think volatility is going to be here in 2024. The reality here, I think, is volatility is here to stay for the foreseeable future. So obviously our U.S. mandates in U.S. dollars performed very well. You all have exposure to the U.S. dollar. I think the Canadian dollar's probably in trouble here, and I wouldn't be surprised to see it turn, down, although it certainly had a bit of a reprieve because oil's over $90 a barrel. That's been on a tear. That's been a cause of concern for inflation, gasoline prices. So, I still think the U.S. dollar is the place to be. On the next slide, what we have here is that. Yeah. Sorry, I thought we had one more slide. So, just in summary, this thing is hard to forecast. There's no question. I feel good that Cody and I have been on the right side of the equation so far this year. When everybody was bearish, and I'm telling you, almost everybody was bearish. They got it dead wrong this year. We were cautiously optimistic. It's working out well. Cody will allude to that as he goes through some of our mandates here. But the reality is it's going to be choppy. And if rates do stay higher for longer, then that poses a bit of a challenge for equities, especially large cap tech stocks, because obviously growth stocks do not bode well to high interest rates. So I think that everybody is underestimating the Feds, and I think that we will more than likely get 1 to 3 cuts in the U.S. In Canada, the next meeting is this month. Yeah, I believe on the 25th. Yep. On the 25th. So with inflation going to 4, do they increase? Maybe. But again, the bulk of the rate hikes are in the rear view mirror. And that's got to be a good thing for equities, and obviously a good thing for bonds, because eventually rates are going to have to pivot and they're going to come down, and that's going to be good for the bond market.
Yeah, they're great. And I think that's a very, very good segue into what my discussion starts off with which is rates, right? And there's been a lot of noise from the recession obsessed to the FOMC meetings as to what is transpiring.
Yeah.
Everybody just has either a super pessimistic or bearish tone, or you find some other people in the camp where they're just kind of patiently waiting it out, right?
Yeah.
So I wanted to kind of break through that noise and kind of dive into kind of take a look at specifically what happened in that FOMC meeting, because there were some highlights that I do want to touch on, kind of look into rates, but this man is causing a lot of noise on the street.
No, but what's interesting about it, if you just take a look at Jeremy Powell, like he's like the presidents of the United States. This guy's aged about 15 years in the last 2 years. So,
well, God forbid, would you want his job doing the press conferences every single time?
This man has the worst job on the planet.
It just seems like he's getting very tired of the same questions every single time he gets asked. He flips through the page.
And he answers the questions the exact same way every time.
Do you watch it anymore?
I don't, because if I hear higher for longer one more time, I think I'll cringe. But unfortunately, I do listen to what he says.
Yeah. And I think it's important to listen to obviously what he's saying, because there is the report that comes out. Markets react immediately, but I think what most people focus on in the market does take into account is the type of language that he's using, right?
Yeah.
So just to break through that most recent release that happened on Wednesday.
Yeah, and just one thing on the Wednesday, I said last week on the Wednesday, he used the word carefully in his speech 5 times, that they're going to be very careful
with how they proceed.
Yeah.
And that is articulated through what I find is a very annoying kind of chart that they put out. But have you seen the dot plot?
Yeah.
Right? So as soon as this comes out, this is what really drives a lot of the volatility right off the bat. So this is the most recent dot plot. And essentially a dot plot each dot represents an individual in the FOMC committee, and where they believe the target Fed fund rate is to land in a specific calendar year. And then they also have the ability to give what is a long-term projection if they wish. And so from the most recent dot plot that they've put out, very confusing, obviously, chart if you have no idea what you're looking at. But what we've seen, and focusing in on 2023, is there was a pause, but they are anticipating one more hike for 2023.
Yeah.
I believe that was the consensus, so it didn't really throw the markets through a loop for the remaining hike this year, but it just goes to show that we are at a stage of plateauing. Rates have reached their peak, and we are plateauing. But the biggest question has been, and what threw markets through the loop on Thursday, and we saw that negative number specifically on the NASDAQ, and even the Canadian market suffered quite substantially.
Almost down 2%.
Was, and you alluded to this earlier, is what happens in 2024. People want to know that, because three rate cuts was what was anticipated. And now if we look at the dot plot in 2024 and the participants' anticipation of what that rate is going to be, it seems as though there's only one rate cut next year. And that's what really the market kind of took to a negative stance.
Absolutely.
Because they anticipated 3 rate cuts. They didn't want that higher for longer phase upon them. But it seems as though the participants in the FOMC are really stuck to that higher for longer phase. And that's what kind of threw the market for a rout over the last couple days here, right? And so we can see that articulated too through the next slide. This is all data taken from the most recent statement that the FOMC put out. So this is directly from the source. But you can see the 2023 range, the anticipation of one more hike happening for 2023. But in 2024, the dotted line shows what was June's projections versus the more solidified bar items being what is the most recent projection as of this meeting. So we've seen a shift out in 2024, meaning, long story short, not as many rate cuts. And that's why the Fed just anticipates this higher for longer regime. But I do actually like his Jeremy Powell's dovish sentiment or dovish comments in terms of treading very carefully on where he stands right now, because I don't think they want to overstep and jeopardize what has been kind of their scenario of a basically soft landing.
Yeah.
Right. So,
and they don't want to upset that apple cart because they're close to achieving it.
They are.
Most times, saying you're going to have a soft landing is just like a pie in the sky type statement. But the reality is, he's done a good job. They're comparing him to Greenspan. The Greenspan's nickname was the Maestro. And, I think the market sometimes overreacts when it says, okay, we're going to get 3 rate cuts. Now we're only going to get 1.
Mm-hmm.
Market going forward is a leading indicator, not a lagging indicator. And these projections about 1 to 2, 3 cuts, now they're saying 1, that could change in a nanosecond.
It could change in a nanosecond, right?
In a nanosecond.
It's all dependent on the data that they are seeing and how they react to it.
And everybody's looking at the same data, and they're just waiting for the same data.
Exactly. But what I think Jeremy Powell and the FOC, they've actually done a very good job of retaining price stability.
Yep.
And as much as they left the punch bowl around for way too long obviously during the COVID pandemic and the recovery, they have done a decent job in getting us back to an environment where we have inflation under control and we believe it's there, but they need to tread cautiously where they stand right now. And I think they are aware of that.
Yeah,
right?
they just don't want to bring rates down too soon and have inflation ignite.
And so you have what
they're
is
just going to wait for the data.
The waves of inflation that happened in the 80s, right? Where you get more coming after through, like I said, waves. But this puts us in a place today where we haven't been in 16 years. So you take a look at the U.S. 10-year, the Canadian 10-year, you have to go back to basically November 2007 to get where we are on both sides of the border in terms of the 10-year bond yield. Substantial. Like the run off the bottom is huge, huge. And so we've come to the period in time where you can see through the dot plot that hikes are in the rear view mirror. They're going to tread cautiously. But it's imperative to understand that these rates being at these high levels, have substantial impacts, like you talked about, on all asset classes, and the valuation that's applied there.
Yeah.
Right? And if we just take, we can stop, I want to stop talking about rates, but it's imperative for our clients and everybody to understand that every single valuation metric, whether you're valuing cash flows, whether you're valuing dividends of a company, whether you're valuing real estate, everything comes down to what is the present value of this specific asset, stock, whatever it may be. You have to discount it and get to the present value by utilizing what is the risk-free rate.
Yeah.
And anytime you take up the risk-free rate and essentially increase the value that is in the denominator of your present value equation, you get multiple compression, right? Yeah. And that's what we've seen happen, obviously, through 2022, but it still continues to happen with the dividend companies, right? They've gone nowhere because rates are so high. Dividends aren't as attractive when we have a risk-free rate, essentially at 5% at this juncture, right? Yeah. And every single valuation metric that all equity managers are utilizing, I'm putting them up there. It's way too much information for you, but it just goes to show you that it's imperative to know where rates are, because rates automatically derive the cost of capital and what is the underlying valuation of a business, real estate, or any type of asset for that matter.
Yeah, and the fear is the multiple contractions on some of these, especially higher price growth stocks. And that's why you've seen this week alone up till yesterday, you've had out of global equities, you've had $17 billion worth of redemptions this week alone. So I look at that one more time and I say, classic case of the retail investor getting it totally wrong. You're selling equities at this point makes very little sense because you know that rates are going to roll over and eventually the value play and dividends are going to become attractive.
Yeah, they become
one more time.
They definitely will be, right? And so I just want to look now like beyond the rates. What are kind of, historically speaking, the market implications that we have for peak policy rates? Okay. So if we really look back at, I would say, the last 4 cycles, basically since 1989, what we've seen that is essentially the time that the Federal Reserve implements its last hike to the time that it implements its first cut is in and around 9 months. Okay. But within that 9-month period, historically, risk assets have done actually extremely well, okay, over those past 4 cycles. And so we take a look at the bottom kind of chart here. We see the monthly average excess return basically between a final rate hike and the first rate cut. And so you can see that value tends to do well. Growth tends to do well. We have a little bit of weakening in the US dollar, but this is an environment where plateauing rates is essentially good for risk assets as a whole. And so in those past 4 cycles that we've seen since 1989, we've actually only had 1 recession happen within 12 months of a final rate hike. So we had our last rate hike by the Federal Reserve in July. We've had some pauses. But if we have one more, there's still essentially, from this historical perspective, a relatively long runway for risk assets to continue to perform, right? And so obviously this period is, it's a challenging environment overall, and we have like US stocks performing better in some circumstances, but overall we think that the risk asset place over the next little bit is the way to go.
Yeah, and I think, the other thing about, everybody with the recession fear, you have to understand that when the yield curve inverts, it usually on average takes 10 to 12 months before you enter into a recession. Well, as I mentioned earlier, the yield curve inverted in July of 2022, and now we're 14 months without a recession.
Yeah.
So,
and it does, like, the market does become more challenging. People need to understand that after the Federal Reserve starts to cut rates.
Yeah.
Right? That's in anticipation of a recession.
Yeah.
They're trying to stimulate the economy. And so what we kind of show here is what has been the actual, after 6 months of the first rate cut, what has been the return on specific segments. So you see a weakness in equities. The place that tends to do the best after the first rate cut is gold, commodities.
Which has been on a terrible downward run.
But the big one being obviously U.S. Treasuries, as a whole. And so that just bodes well for anybody that's buying U.S. Treasuries at what could hypothetically be the peak.
Yeah.
Right? So what our strategy, I think, based on kind of what we've interpreted, Ken and I have discussed, is 3 main points. One is we want to continue to lock in our bond yields, and we want to maintain high credit quality.
Absolutely.
Okay. We think it's imperative to avoid what is the cash trap at this juncture, because there is a temptation for investors to go into cash. You have the ability to go into money market at 5%, but you can't lock in cash without facing severe reinvestment risk, which is GICs.
Yeah.
So GICs are technically not an option because of that reinvestment risk that is far too high in our opinion.
Mm-hmm.
And if you are in cash and bond yields are starting to fall and we do enter a recessionary environment, that yield you're generating on cash evaporates. And with the drop in yields, you get, with the inverse relationship, an uptick in the bond price. So with rates at their peak, we believe medium duration assets around 5 to 7 years is the place to be in terms of fixed income. We want to maintain high credit quality. Also, we're really focusing on avoiding the high yield space at this juncture. The chart there shows you specifically high yields actually performed very well this year, very well. But it's in a place in terms of spreads that tends to be overvalued. So I think there's going to be a widening there, hence why we just want to stay in the higher quality names, pick up in terms of our duration because we think that the benefit of a cut is definitely going to be there. And we do have a slight allocation at this juncture, which may add a little bit more, but a little bit stepping into long-term bonds.
Yeah.
Long-term bonds extend your duration a little bit, but really provide you with that recession insurance. And the whole point of the fixed income portfolio is to provide you with protection against a recession. And by adding those longer duration assets, if we do get that scenario in a recession is always going to be inevitable. A recession is always going to happen. That's the cyclicality of markets. So anytime that there's a bear out on the street predicting a recession, he's going to be right at one point in time.
Yeah, it just
But
depends
how-
on
depend-
how
how long?
long
How
it
long?
takes to be right. And
Right?
with the S&P up 13%, and 5% in cash isn't looking so good now.
Not looking so good, but it's that importance of diversification and having uncorrelated asset classes protect you if that is inevitably sped up and that recession does come to fruition. So that's the strategy on the fixed income side as a whole. Our second kind of strategy and viewpoint is we continue to hold our equity set and exposures. We believe that the plateau, as we've shown you, is good for risk assets as a whole, but we also believe that over the coming quarter, with the resilience of the U.S. consumer, an improvement in sentiment amongst those consumers, that it's going to be good for not only the IT segment of the United States, but we'll be able to broaden out the performance of the S&P 500. So trickling into materials, trickling into consumer discretionary over the next quarters as we kind of see things start to obviously improve.
Well, take a look at Amazon. Amazon just went out and is hiring 250,000 people for November and December for the Christmas rush. So they obviously believe, wholeheartedly that the U.S. consumer is still showing strength.
Yeah, it's still showing strength, and now there's a couple risks there that I'll touch on later. But you can see on the far right slide here is you graph CPI, which is the gray, you graph red, which is the sentiment. There's been obviously inflation coming down, which has been obviously positive for consumer sentiment. Like we said, their spending, touch on it a little bit later, has been questionable, but they still seem to be spending dollars. And that is going to hopefully drive what is the earnings component of the consumer discretionary and other sectors on the S&P 500 to achieve what is a broadening. And we're hopeful that over this coming quarter, that will be shown in a broadening in terms of our high income strategy, Canadian equity, also our Verus small to mid cap, and then also our international as a whole, right? But the one thing also that's been driving most of the equity market rally this year has really been just as a whole has just been rising valuations.
Yeah.
The earnings have remained relatively flat, but are expected to rise in 2024. So that is a big kind of question mark on the horizon is, can the U.S. consumer remain strong, and can corporations continue to achieve what is the anticipated earnings growth that is heading into 2024, right? But over the next quarter, we still believe that there's going to be strong equity markets for risk assets, and obviously, hopefully that will broaden out a little bit than mainly just the IT stocks.
Yeah. Yeah, it would be very good to see a sustainable broadening of the market to get away from all the pure growth stocks. Then that the markets, have the ability to be resilient for longer.
Yeah.
We need more companies to join the party.
Yeah. And our last viewpoint and kind of strategy heading into this quarter is just continuing to be diligent in our allocation and use of uncorrelated assets. The use of strategic alternatives that aren't related to bonds, aren't related to equities. And it's been a strategy that is held up regardless of what the market has been throwing at it. And the managers within Verus Strategic Alternatives, specifically our multi-strategy hedge fund component, which is managed by Polar Capital, those managers have the ability in whatever market environment or whatever volatility is thrown at to make specific calls and capitalize on specific segments that you and I wouldn't have the ability to do so, right? And so it's adding those uncorrelated strategies, keeping them in the portfolio to really alleviate some of the volatility and pick some spots that we wouldn't necessarily get access to, right?
Yeah, exactly.
So kind of some of those 3 points is the fourth quarter, broadening, keep our fixed income position in play as rates peak, continue to use our alternatives to add uncorrelated positions. But there are, I think, it's not all rosy ahead.
No.
Right? And this is where the risks lie, I think, heading into 2024, where we may need to start to look at readjustments. But there are 3 concerns that I specifically have, and I haven't really talked to you about this, but that could hypothetically come to fruition, right? So one was the consumer resilience being tested, right? We have apparently a higher for longer central bank position. Having higher rates for longer puts obviously stress on consumers month in, month out. You continue to just stress them, right?
Yep.
And so we have it's a risk. We have at this point, households are coming close to completely depleting all of their savings that they built up from the COVID-19 pandemic. They have also reached a point in time where we have credit card interest payments almost reaching all-time highs. So it's becoming a little bit scary. And
the balances are at all-time highs.
And so it's becoming a little bit scary from that point. It's something we are watching closely because consumer spending, being a large part of U.S. GDP,
70%
drives the economy. So one area of concern. The other that I have is Canadian real estate. With the mass amount of hikes that we've had, although we've seen some compression, it wasn't to the level that I thought was going to transpire, to be honest with you. And I know it takes a long time for those higher rates to inevitably lead into the real estate market and start to affect valuations. But I'm of the opinion that mortgage delinquencies will start to increase. Okay?
Oh, yeah, there's no question about that. And what's going on in the Canadian housing market right now is you have, the Bank of Canada and both in the States, they wanted to see a much bigger contraction in real estate prices. They didn't get it. And so now you have a limited amount of supply on the market, and part of the reason for that limited supply is people are actually listing their houses and then taking them off the market because they can't find another place to buy. So yeah, there's challenges ahead in the real estate market.
There are, and like you take a look at the 2026.
And I don't like to say that, by the way, because I'm still trying to sell my condo in downtown Vancouver, which has been a very difficult thing to do.
Yeah, and I don't like to say this next point, but we are approaching a period in time where the people that bought homes during the pandemic, locked in at low interest rates.
Got 2 more years.
Yeah, but 2025, 2026, if rates stay where they are, you are now refinancing at 4% above where you currently are. And for the average person that is just barely scraping by and just got by what was that total debt to service ratio, the stress test, the gross to debt service ratio that they apply when you're getting mortgages. If you haven't substantially made more money over the last 5 years and you have to refinance at these rates, your monthly income is going to get annihilated. And so we have a point, so that's a concern with the impending maturity and rollover of these mortgages. But you also take a look at BMO, TD, and CIBC have actually approximately 20% of their mortgage books in what is negative amortization at this juncture.
Yeah.
And so that's crazy. So negative amortization essentially means that you end up owing more on your original loan than you originally started with.
Yeah.
So it's scary space. That's our second risk. And I think another thing that's out there, and you alluded to the S&P 500 debt being far out in maturity. But what is of concern for me is, yes, the S&P 500, those are all large cap names. But there are the smaller capitalization companies, the high yield issuers that locked in at low rates still are there, but some maturity walls are happening through 2024, 2027, and there may be some issues in that space of corporate America that may come to fruition sooner than later here. And so those are 3 of the risks that I've kind of outlined that I think are in the back end of 2024 because it does take a long time, and these are all kind of they're really credit-derived issues, right? And the thing with credit is we just peaked in terms of interest rate, and it takes a long time for those rates to ripple through every single crack of the economy. And so...
And a much longer lag time with real estate.
And a really long time with real estate. But inevitably, they're going to get there, right? And so if these continue to persist, those are things that we need to watch and potentially adjust as we head into the middle of 2024 and maybe the back half there. But there's things that we obviously want to watch. We're diligent. We're focusing on just this year for the time being. And we hope that the remainder of the year will be strong and we'll see some broadening out. So the last slide that I want to end on is just the mandate returns. Don't worry if you can't catch all these, but we are producing obviously all the fact sheets. We are having a luncheon on October the 19th, so we'll be going through, I would say, I will be going through more of these mandates in depth at that point in time. I wanted to save some of those conversations for 30 days from now, basically.
Yeah.
But overall, we've seen fixed income essentially go nowhere. We're slightly down for the year as yields have been higher for longer. We're not anticipating the rate cuts, so that has put some pressure on the fixed income space. So it's been muted. Same with the high income, which is our Canadian dividend strategy. As rates are higher for longer, dividends aren't nearly as attractive if the risk-free rate is high.
But it was our best performing strategy in 2022.
Exactly, in 2022. So the majority of the return attribution for our clients this year has been mainly in the weaker segment that happened in 2022, but it's the U.S. and international names, right? We have U.S. focused growth being up 22%. Our international strategy up 13. The small to mid-cap space up 6.6, which is way higher than the Russell, just at 1.6. So outperforming dramatically. Infrastructure, again, very cash flow orientated, not really going anywhere. So you can really see the trend and why rates are so important to understand in terms of the equity returns that we're receiving. And last but not least is alternatives trekking along, doing what it's done. There's been a little bit, obviously, on the private side of real estate. Haven't really seen it so much in the public side, but there is a lot of repricing of real estate assets going on behind closed doors here. There are some spaces that are severely impacted, and I don't think have actually really felt the raft of it yet. U.S. office.
U.S. office space.
U.S.
number
office
one.
being one of it. I've heard some horror stories on the private side, so that is also another concern. But our manager on the real estate side, and this is why you need to have an active manager in real estate, you need to know your positioning in terms of sector.
Yeah.
And UBS, Global Private Real Estate, institutional manager, has at this point in time in terms of its entire portfolio only a 2% weighting overall to U.S. office space. And that U.S. office is actually linked technically to healthcare as a whole. So they're not in really segments of that space that we think could come under severe compression. So this is just the overall mandates. Again, like I said, we'll touch on this in the luncheon. And the fact sheets are going to be coming your way, but hopefully we can see a broadening out. We'll hopefully push high income into the positive territory this year, hopefully push global infrastructure there as well, and maybe even get a little bit more return out of U.S. focused growth.
Yeah, well, I think we're going to get more return out of the small cap, the international, and the U.S. focused growth, because don't forget, there's another risk out there that we have to deal with, and that is yet one more time, McCarthy, and the debt ceiling. Okay, so what happened when we went through the fiasco a few months ago and, pushed right to the brink? So everyone was concerned that the debt ceiling wasn't going to get increased. It will get increased again, for sure. Yeah. It always does, but not to the bottom of the ninth inning.
Until somebody gets their way.
Until somebody gets their way. And as we, have the U.S. elections, not that far out, it's going to get more and more political based on, raising that debt ceiling. But take a look at, if we learned a lesson, where did people flock last time there was a concern? You would think they would flock to the U.S. dollar, or they would go to value stocks, dividend stocks, but they flocked to safety. Investors flocked to safety. But where they viewed safety was in the mega 7 big tech stocks. That's where the money went. And I see that trend continuing, and that's why I'm still very optimistic about our U.S. focused growth in the mid-cap U.S. and also the international. So I think the others have the potential to join the party, which is what we need, but I still think there's more upside in those three areas.
Definitely. Great. So just some administrative items to go over before we let all of you go. Is we do have a new website.
Well done, Cody.
So
well done.
The one thing being that I wanted to walk you through, and I'll walk through at the luncheon, but we'll also produce a video about this, is I really wanted to outline the resources that are available to you. Okay? And we've already had some calls and questions about where do I access certain things. So when you open up the menu, and it's a new menu that's in the top right-hand corner of the website, and it's called a little hamburger menu. It's like a mobile menu. If you open it and expand it, you need to click essentially the menu item that says clients. Okay? And from the clients section, you have essentially two options on where you can go. And this is pretty imperative because I think some clients didn't understand that there are two very different portals that you can access. Okay? The first portal is National Bank Online Access. Okay, so National Bank Online Access is essentially how do you view your accounts online. You want to see the change in your market value, you want to see your statements, you want to collect your tax slips. You click that, you'll be redirected specifically to the National Bank portal. Hopefully you've already saved your username and password in your browser, and that will allow you to access all your statements, see your market value on a daily basis. Okay, that's one section. The other section that we provide access to all of our clients is the Verus Financial Client area. Okay, this is a password protected portal in our website, and it has a common password for all clients. So when Carmen's sending out emails, the password that we attach in those emails is accessible for everyone. It's not your own specific username, okay? And so within that client area, unlike viewing your accounts, this is items related to Verus. So it incorporates 4 key things. 1, access to your wealth notes, access to our wealth notes. So all of the preceding 4 quarters of the wealth notes, you click on the box, you download it, you'll have the ability to view the specific wealth notes.
And you can go back to past issues to see whether we got it right.
Exactly. We can go check our work, right? Yeah. The second item is video presentation. So we have access to our quarterly podcast.
To have that still photo like that. It looks like I'm full of air.
But you can access all of our quarterly podcasts there. We also have the other luncheon presentations as well down there. So all videos are accessible through there. Another thing that everybody well knows is we're huge on investor transparency. We added the portfolio section and have kind of updated it from our previous website, where you have the ability to download the fact sheet, you have the manager commentary, you have the investment policy statement for all 7 of our individual mandates. It's all there. Go through it, all accessible and updated on a quarterly basis. And the last section in our client area being the resource center. If you have any questions in relation to what are my RSP limits, what are my RIF withdrawal limits, old age security, Canadian pension plan, any kind of additional resources in relation to tax, there's a great resource section available to you at the bottom of our client area. Please go utilize it if you have any questions. It's a great place to start. Like I said, if you don't know specific things, always give us a call, but that is accessible to you at all points in time. So that is the website.
Yeah, I just want to make one comment on the fact sheet. If you're going to, look at anything, I would really strongly encourage you to spend a little time on the fact sheet. Over the last 40 years, I've been pushing alpha, beta, R squared, upside, downside capture ratio. And as Cody alluded to, we firmly believe in full transparency. You get to view the top holdings, you get to see all the risk statistics, and you can really see why we have a passion to be proactive in selecting these managers, and you can see whether they're doing their job. And very few people in the industry provide their clients with this level of transparency on the fact sheet. So if you spend any, time on our new website, please do spend some time on those fact sheets, and I think you'll get a higher degree of comfort and conviction of why we're using the managers that we are.
That's great. And just to elaborate one more time on that point, on the website, there is the ability for you to download the fact sheets, which has the full details. But if you just wanted a quicker snippet of each portfolio, there is actual performance details updated on a quarterly basis through the portfolios section in our menu.
Yeah.
And last but not least, last item that we have is our Verus luncheon. Do you like that photo?
Well, I don't know. I'm starting to look like Jeremy Powell. I'm a little concerned.
But we are having our luncheon on October the 19th. Sorry, there's a spelling mistake in there. I don't know why I added the 19th and 20th. But it is on October the 19th. We will be sending out a link to RSVP. So if you could please, if you are planning to attend, please go through the webpage that we are going to send you, fill out the RSVP details so we can have an accurate record of who's attending. But it'd be great to obviously see everybody there.
We would like to see you there.
Yeah, it should be.
Mark your calendars.
Mark your calendars. Good event as always, and obviously it's kind of a short lead time between this podcast and the actual.
Yeah, but the markets are going to change so rapidly in the next month.
I know we have plenty of content,
plenty
so
of new things to talk about.
We'll have lots of time to go over the mandates, other items. So
don't worry, Rob. There will be wild salmon. Don't worry, everything will be good.
Great. Well, appreciate everybody taking the time to view this video, and we hope to see all of you at our luncheon on October the 19th. All right.
Yeah. Thank you very much for taking the time. Appreciate it.